Let's value Amazon business and arrive on whether it's a good investment today. We have big news because they reported full year 2021 earnings, and that shook completely in their financial numbers. In this video, we will look at how Amazon business is evolving and calculate the intrinsic value with a discounted cash flow valuation. Let's dive into it. Amazon needs no introduction, and in their financial reports, they account in three business areas: North America, International, and Amazon Web Services. The North America is the biggest part of the revenue pie, accounting for 60% of the sales, International for 27%, and Amazon Web Services for 13%. Obviously, the biggest revenue driver of Amazon is its e-commerce business and related products, which are accounted into the North American and international areas. So if we break down North America and international in different business areas, we can see that the biggest part of the revenue came from online stores, 48% of it. This is the core e-commerce business. We also have the revenues from physical stores in orange, third-party seller services, which include commissions and any other related fulfillment and shipping fees from third-party sellers, subscription services, this is both Amazon Prime and subscription for ebooks, audiobooks, etc., and advertisement services, for example, for making a product rank on top when you make a search in their e-commerce platform. We then have Amazon Web Services at 13% of the revenues and others at 1%. The graph on the left shows the growth year over year in Q4 for each of these areas, and we can see that Amazon Web Services and advertisement services grew at the fastest pace, over 30% year over year. So, although the two segments combined only make about 20% of the revenues, they might become more and more important part of the revenue pie in the not so distant future. And it is particularly exciting from a shareholder perspective because they are two areas with high margins. Now that we have an overview of the business, let's dive into the financial metrics. Amazon has been a growth machine in the last decade, printing 25% compounded annualized growth rate in revenues from 2012 to 2021. Amazon turned positive in the bottom line or net income in 2015, and it increased ever since to 33 billion in profits that they just reported in 2021. Bear in mind that the 33 billion mark is inflated by 11.8 billion in valuation gain on their equity investment in Rivian Automotive. So it is not all driven by the core business profitability, and that's why it's dangerous to look only at net income. In fact, cash flow from operation is where things start getting ugly. Up to 2020, it grew consistently from 4 billion in 2012 to 66 billion in 2020. However, as you can see in 2021, it dropped to 46 billion. It is not great to see, and it means that their core operating business did not do as well in generating cash. In parallel to that, property, plant and equipment expenses grew steadily over the years, and they particularly jumped in 2020 and especially in 2021, when it registered 61 billion expenses. In principle, this is fine because they are investing massively in growth, and it is also a good thing to see from a shareholder point of view for achieving long-term growth. However, this combined with the lower operating cash flows meant that the free cash flow for the year was negative, and you can see that from a historical perspective, this is the first time that it happened since 2012. I don't like to see that. I see Amazon as an established company that sure has growth going forward and should capitalize on that, but that should also provide the free cash flow stability that a trillion-plus-dollar company should be able to live up to. And perhaps fair enough that I'm biased by my own way at which I look at Amazon, but I really don't like and don't accept such high volatility in free cash flow generation. Share outstandings have been growing but at a lower pace, just 1% compounded annualized growth rate, so it's pretty stable. However, you can see that they are not diminishing, and there is no dividend payout as of now for Amazon, so Amazon has no way to directly reward shareholders. When we look at margins, we can see that it is very positive that gross margins increased over the years, from the mid-20s to above 40% in this last reported year. Operating margins stabilized in the 5% range in the last 4 years, and net income margins got steadily better, reaching 7.1% in 2021. Remember though that as we just discussed, this great 7.1% figure is biased by an unrealized equity gain in Rivian. Free cash flow margins is where the pain comes, because they turned negative this last year. However, if we look at the longer time frame, we can see that from 2015 we had consistent about 7% free cash flow margins, apart from 1 year drop in 2017 and in 2021. So on the positive, I think that the business is able to indeed to sustain a 7% free cash flow margin over the long period. Some ups and downs, but on the other hand, I'm really not excited to see this inconsistency and especially years with negative free cash flows. Nevertheless, based on these numbers, I will use the 6 and up to 7.7% free cash flow margin figure to estimate future free cash flows, because I do believe that it is the most likely result from the long term with the data that we have available today. Also, I do want to believe that Amazon management team will mitigate these extreme capex investments in the years to come and print more consistent margins. So let's move into estimating future free cash flows. We have in red here analyst estimates from Amazon revenue growth in 2022 and 2023. As you can see, analysts are estimating that revenues will jump 15% and 17% as compared to the previous year. The question is, will Amazon revenue growth be able to keep up this double digits increase for the next decade? Or size will get in the way and they will start slowing down in the years to come? I think that with all the capex investments they are doing now, the strong business moat that Amazon has now, it is safe to assume that the double-digit growth will continue for a while and then will cool off. So I put a progressive decline in revenue growth in the years to come, where in 2028 we'll shift to single digits revenue growth, and in 2031 it will be all the way down to 5% growth. Despite this decline in revenue growth, this calculation would assume that in 2031 Amazon will have almost 1.4 trillion in sale, which is pretty mind-blowing by itself. For free cash flow margins, I assume a 6% figure for the next 5 years, which then it will increase to 7.5% for the 5 subsequent years. This is based on what they showed us that they were able to print in the past. However, I can totally see an argument that the margins will get better than this in the long period, if capex spending will cool off. However, I like to keep my estimates conservative, and I don't want to assume better margins than what the company has showed us that is able to print. One thing I would expect for sure that margins will be volatile on a year-to-year basis, but I do think that they will evolve around these figures. Multiplying the revenues by the margins will give us the predicted free cash flows that you see here in this row. Okay, let's paste the predicted cash flow values in the discounted cash flow valuation model in this row. We have the discounted values in the row below. The discounted factor we set it to 7.52%, which is the weighted average cost of capital. If you are interested in seeing how I calculated it, you can stop the video here. Over here, we calculated the terminal value of the business with two models, the terminal multiple and the perpetual growth model. And then we took the average of the two in here. For the terminal multiple, I looked at the price to free cash flow valuation of Amazon from all the way back from 2006. You can see that for most of Amazon history, investors have been valuing the business at very high multiples, where the average of the period has been 93. In the long term, however, if growth rates slow down, I don't expect the multiples to remain nearly as close to these values, so I set a terminal multiple value of 30, which is rich by itself and reflects the premium with owning Amazon. For the perpetual growth model, I chose 2% as the perpetual growth rate. In this cell, we have summed the future discounted cash flow with the average terminal multiple. Here, we correct for total current assets and total liability, and dividing by the share outstanding gives us a fair value of the business of $2,913 per share. Given that Amazon trades around $3,070 as I'm making this video, so right now Amazon trades slightly overvalued based on my calculations. So the good for Amazon is its immense moat that they have built, the warehouses, distribution centers, logistics, and so on. It is going to be unimaginable for a small player to attack that. Moreover, I think that the total addressable market is far from saturated. I know many people who don't buy from Amazon on a regular basis, and they might therefore become clients in the future. It is not like Facebook where everyone you know already has a Facebook account. So I definitely can see double digits revenue growth for many years down the road. Another good is that they are tackling new markets and revenue streams continuously. Video, music, expanding their Amazon Basic portfolio. There is basically a lot of path for growth. They also show to have pricing power. For example, in this last conference call, they announced that they will increase Amazon Prime membership fees from $12.99 to $14.99 per month in North America. And I don't think that anyone is going to drop it due to the price hike. They are also starting to get traction in India, and they announced that during the Great Indian Festival, nearly 30,000 sellers surpassed the $100,000 in sales in Amazon.in. Finally, we can't forget that Amazon is in a secular tailwind industry where consumer preference turn to a more and more online for shopping. On the negative, regulatory pressure could intensify. Amazon is already on the watch list of regulators due to its power, and there has been some scandals here and there with Amazon Basics preying on third-party sellers. Also, the European Commission has proposed a directive to ensure a global minimum effective tax rate of 15% for large groups operating in the European Union. This will probably have a negative impact on Amazon profits, and we shall see in the future earnings how much of an impact that will be. Amazon is a $1 trillion corporation, and although the management has been phenomenal in delivering growth, size will probably at some point come in their way and slow them down. Another thing I don't like is the fact that they are such a mature business, but yet their free cash flow is so volatile. I would like to see more consistency there. In conclusion, there is no doubt that Amazon is a fantastic business with a gigantic moat and many growth vectors. However, my discounted cash flow valuation shows that it is fairly priced or slightly overpriced, so I'm not eager to jump into the investment at these levels. Moreover, there are some aspects that I'm not happy about. There is uncertainty about how much the European 15% tax rate will impact Amazon, and I'm not happy to see so much volatility in free cash flows. So overall, Amazon is on my watch list, but I'm not adding. That's it for today. I hope you got value out of this video, and let me know in the comments what you think of Amazon as a stock to own at these levels. See you in the next video. Before we go, I must remind you that I'm not a financial advisor and this content is not financial advice. It's just my opinion and you should do your own due diligence before investing in any product. Have a great day.